Hey guys, very good morning. Welcome to the briefing for Wednesday, the 23rd of November. Let's get things underway as we've already seen a couple of data points come out, bit of market movement this morning. You can see on the top left-hand corner of the charts I'm sharing, Euro, dollar and cable are already on the back foot this morning. Actually, this is in spite of, generally speaking, okay data coming out thus far. We've had preliminary figures for PMI, both manufacturing and service figures for France and Germany. Let me just switch over and you can see the numbers themselves. So German services 55 against expected 54. Manufacturing a touch weaker at 54.4 against 54.8. The French numbers slightly better on the service figure and a touch beat on the manufacturing side. So overall, I would say the market not really reacting too much to the data. Whenever I see both major pairs moving like this, I would say this is probably more a dollar play, and especially given the dynamic that the dollar has been a big driver of the FX market really since Trump won the election. Just keeping an eye here on cable. We're just making a test now on that low print that was seen yesterday evening, 23.90 just giving way. Obviously seeing a bit of a reversal of that more aggressive move that was seen back on Monday. Euro as well then under a bit of pressure. Again, I don't think this is really a reaction to the data, it's more of the dollar strength. And looking at the euro, so in these two charts that I'm sharing at the moment, you've got the euro dollar pair, then you've got the Bund future in the bottom corner. And I think this is kind of a theme which we saw yesterday and we could be seeing over the next couple of days, as the kind of political uncertainty that may well arise as we get closer in toward the beginning of December for the Italian referendum. We've obviously talked and discussed about the other risks associated with France and the populist rising. And ultimately this comes in the context of a rising interest rates in the US and inflationary environment which is more hawkish for the dollar. So it's almost a perfect storm for euro dollar to move lower. Also, more of a catalyst then for the ECB to just extend their quantitative easing program, which has kind of kicked the can down the road to some respect. But it seems as though fixed income markets certainly starting to price that in to a certain degree. Bunds were outperforming T-notes yesterday. If I look at T-notes, we're already up around 3.5 ticks. Bunds already up around 29 ticks, testing that R1 this morning. That was after a pretty decent move that was seen in yesterday's session as well, around a similar time. So maybe a bit of just positioning now in towards the prospect that, well, the ECB accommodation is here to stay. Likewise, euro. Now, this is getting more interesting. Obviously, Piers was talking on CNBC yesterday. You may have called that interview, but it's kind of the view which is becoming more of a growing consensus, I guess, on Wall Street, is about where does the euro go from here, stretching the chart out a bit longer to encompass the last real kind of 2 years, I guess. There's a couple of big levels that start to come in. This is a weekly continuation chart in the euro dollar future. This is down at the 105 type levels, because once you get underneath there, then obviously there's a bit of open ground then towards the big one that a lot of banks are starting to see as a potential risk or a target, is parity. Parity in euro dollar obviously has not been seen. You know, looking on these charts, a monthly continuation, you have to go back to December of 2002 when we were last at that point. But you can see here that fundamentally the situation of particularly politically, which has been a big driver of financial markets in 2016, that's all erring on the side of caution, not forgetting as well that Europe also has to navigate the Brexit negotiations, which is also more or less lean into a negative situation more than anything on potential contagion effects. And then other than the two main Italian and French events, you've also got German federal elections, Austria, Netherlands and so on. So a lot of risk, and coming in the context of what I foresee as being a strengthening dollar for the time being on the kind of short to medium term as Trump gets underway and Fed policy takes a new change of direction when they hike rates in December. So Once those levels down here start going technically as well, with the fundamentals lining up, then I certainly don't think you can rule out parity. In fact, SocGen yesterday is saying that we'll get there before the French elections even happen. So that's the direction. Obviously, you've got to know, again, it's the discipline about, there's certainly a bias in play, but now it's the patience and having to execute it in a technically sound way. And what I'm talking about is the entry and exits. Equity markets, a little bit more tougher to call. I mean, I look at the S&P and at least it's a bit more cleaner in the price movement. If I just make the chart a bit bigger, obviously 91.5 was the previous record high. We managed to get through that after the European close on Monday. US markets really broke that level, and in Asia really bid up the market to those new highs at 22.03. You can see though how that previous record high is defining the kind of low now of this new range that we're in. Yesterday around European cash close we got close to it, and then we rallied up aggressively through the NYMEX pit close and all the way up to the close on Wall Street, which actually we were back up at record highs again. So certainly I'd say that these ranges are going to be quite important, because this is a holiday shortened week, and there's going to be a lack of liquidity and participation from a US point of view. The pits will be closed Thursday. Electronic trade is happening, but reduced schedules on both Thursday and Friday as well. So maybe we just get a bit of a price action locked within these boundaries for the time being, barring anything unexpected. The DAX, though, a lot more difficult to call. Just looking at the price action this morning, I mean, it's not really reacted to the data coming out. If I just break it down maybe into 5 minutes, you can see here the open 8 o'clock, a push lower. But again, just given the fact that really I think the market is digesting the broader macro themes at the moment, that being Trump and the political risk. Economic data, I think, has really taken a bit of a back seat. The economic data this morning out of Europe is fine. US, likewise, housing data and so on has been fine. And the fact that a Fed hike is already priced in, I think that identifying the ranges is what's going to be important, especially when the markets get very quiet during Thanksgiving, which kicks off obviously tomorrow. So a little bit rough around the edges, but the S1 and pivot holding in the DAX. One of the guys was in an early trade in the DAX, and I was just kind of pointing out to him that you just need to be very proactive if you're looking to enter that market very early around cash equity opens at 8 a.m. because the future does have the propensity to be quite choppy at the open, much like we see a similar theme at the open of Wall Street trade in the US index futures at around 2:30. So you just need to be a lot more realistic in your time frames, given that price action can be pretty whippy at that time of day. But certainly, I think identifying ranges is going to be a key thing for today and the next coming days. A quick look at a couple of news stories then of note to share with you. And obviously oil has been a talking point, always is, when we get close to an OPEC meeting. For any of the newer guys, the OPEC and oil producing nations, they love to speak and give their 2 pence on what their current thoughts are, and that can provide you with some quite good trading opportunities if you're able to action in quick fashion most of the time. But I think this chart really is a classic example of OPEC at play, in that you kind of get these quite aggressive moves. Nigerian delegate says committee on course to agree details of a cut. The market rallies, and then within a couple of hours, OPEC committee said to defer final details of cuts to the ministers on November, i.e. the technical meetings they've been holding in Vienna in the last couple of days have amounted to nothing. The market comes off again. It's this kind of seesaw battle of what I call headline noise of various nations making comments is very normal behavior from OPEC. They're quite unique in that way, and the market knows this, and it's for those more comfortable with being more aggressive in their trading style and reacting to news, then certainly this does offer some opportunity. Explaining though why the deal is breaking down a little bit is, I think, quite well explained by these graphics here by Bloomberg. And what we're seeing is that, you remember the headline yesterday, the market came off a little bit in crude, and it was because although they were looking like a deal, according to Nigeria, was getting close, actually it was about being contingent that Iran, Iraq, and I think it was Indonesia, was said that they weren't happy with the current discussions that were going on. Now, the reason why this is interesting is because Iran and Iraq have been trying to ramp up their production to record levels. And actually, if you combine the percentage value, they're getting ever closer as a duo of rivaling the same sort of capacity that's been a monopoly almost from Saudi Arabia for such a long period of time. Therefore, any deal being made, not only is it becoming increasingly important that the likes of Russia and Saudi, the kind of power brokers are involved, actually if Iraq and Iran work together, they too can be a real deal breaker of an agreement going through. And so this is why when you have those types of headlines, it's important to know your 14, let's say, OPEC nations and where they lie in the size of production values as to how impactful their comments will be on underlying market prices. Moving this on one step further, you can see here how these different lines, really it's the two top ones. You've got Saudi Arabia, their million barrels per day of production, you can see tracking just above 10 million. But if you look at Iraq and Iran, they've really been trying hard to catch up. Iran makes sense because obviously they were subject to sanctions for such a long time. They've been pretty vocal and aggressive in ramping up production, but it's the combination of the two that means that they're becoming ever more powerful. So with this being said, obviously I would continue to be very vigilant for any breaking news, Reuters, Bloomberg sources, OPEC related of that nature. But the latest state of play seems to be that they've deferred any real decision making until the official meeting in Vienna on the 30th. Sticking with oil, obviously we've had the API crude oil inventories come out last night. Looking at the chart this morning, let me just quickly bring that up and share that with you. So just looking at where prices were at around 9.30, you can see we've really not had any firm direction here. The numbers themselves, crude was a surprising drawdown of 1.28 million. Expectations was for a build of 1 million. Cushing, a draw of 140,000. That's pretty much in line. Gasoline, though, was a build of 2.68 million, much bigger than expected build of 900,000. So looking at this data in summary, as a collection of all the data points, this is a bullish number, obviously. However, this is, I would say, more bearish than that is bullish. By that I mean that the differential between how much that's beat and how much that's a bigger build, I would say they're countering each other, and so net, the whole report is what I would deem kind of net neutral. And so therefore this is when you get this kind of indecisive price action. Someone was asking me this morning what I think about oil from these current levels. Well, again, I would sort of be out of the market on the reluctance to enter because of the associated risk of a headline breaking and getting caught the wrong side of a spike in prices. Now, I think that's lessened slightly given the recent comments that they're deferring decisions till the 30th. But this inventory data, for me, does not give us any real direction, because you've got a bullish headline for crude but a bearish headline for gasoline, and net the report is quite neutral. So I think pivot might well just contain, and the price might be magnetized to that level until obviously we get the DOE crude oil inventory levels later on this afternoon. On that note then, let's have a quick wrap up and a look at the calendar for today. As I said, you've already had the various manufacturing service PMIs coming out of Europe. This afternoon you've got durable goods orders, which would normally be important for the US alongside the weekly jobs data, but again I think this is really by the by at this point that the Fed's decision is almost 100% for December. This really isn't going to change their mind. But nonetheless, keep an eye on that when it does come out, I guess, for any short-term intraday fluctuations in the US dollar in particular. The Michigan number is a final reading. This normally comes out on a Friday. Obviously, it's been front-loaded to Wednesday given Thanksgiving tomorrow. And then we've got the Department of Energy numbers later. This is actually a typo on the calendar for the FOMC minutes. This is coming out at 7 o'clock, of course. But we will not be open myself to cover that, but the Squawk service will be covering that as per normal. For anyone trading the pound, obviously a couple of events to be aware of. I'd say the pound this morning is being influenced by some renewed strength for the here and now in the US dollar. And we just tested and found a bit of initial support here around that low print from yesterday. However, two events to be aware of. Christine Forbes, who's one of the more hawkish members of the MPC. She's speaking with pre-prepared text at 9 a.m. this morning. So be mindful of her comments. They're coming out in 7 minutes' time. And then you've got Chancellor Hammond, obviously delivering the autumn statement. Now, a quick word on the statement. I mean, for you guys, we're not trading here at Amplify individual single stocks. And I would say, as a trading opportunity, having worked on an equity desk, more broadly speaking, it offers up, this is the UK budget, better trading opportunities if you were trading single stocks. By that I mean any decisions that the government makes about banks and ring fencing or new policies that they want can obviously move financial stocks. Anything mentioned about housing development packages to say stimulate growth on the housing sector, stamp duty talk, that can move individual home builders like Barratt Developments, or estate agents like Foxtons and Savills can move. So it's all very much tied towards the individual statements that he makes and then the companies that provide those services. From a broader macro point of view, things to look out for are you've got the Office of Budget Responsibility. They work in conjunction with the government. They will release their latest UK growth forecasts, and anticipation is for a downgrade of UK growth to 1.3% in 2017 from previous 2.2. That's understandable. Obviously, this is post-Brexit now, and that will need to be revised down. I don't think that will be a particular shock to the market. Other things that the financial market generally looks at, this is just for your broader knowledge, is that the DMO, which is the Debt Management Office in the UK, also gives their forward-looking expectation of gilt supply going forward, which can have an impact on gilt futures. But any movement in gilt futures these days doesn't have much of a read across into bunds. So again, from the instruments that we're looking at, not too much to worry about there. In terms of how this comes out, though, obviously there's no pre-prepared text with this. Hammond just starts delivering his first budget. The comments will be trickling down the news wires, so you have to kind of just monitor it as he makes the comments live for any potential ramifications for the pound. But I'd say this is probably to a lesser extent going to be impactful on the FX markets unless something very surprising is said, or let's say the growth forecasts are downgraded dramatically. But again, that's kind of slightly, I'd say, politically unlikely, given that they'll want to show an air of confidence that they have control over the economy. So the budget, not so much of a big deal. Okay, guys, going to wrap it up there. You've got Christine Forbes coming out in a few minutes' time, speaking top of the hour. You also get the European final reading, or PAN reading, for the service and manufacturing PMI. So enjoy your session. Again, just to remind you to remain disciplined in these markets. I would say the market so far in the last 2 days has been relatively indecisive. So I would be realistic in your time frames of your trade targets when you are in trades, and your time frames to hold those trades over, because there has been a propensity to the market to be fairly choppy in what has been quiet conditions, which is a kind of reflection of the probably lower liquidity. Okay, guys, enjoy your day, and I'll see you in the chat. Thank you.